Hello, I'm Greg Bunnell. Welcome to Market Call tonight. Our guest is Kim Bolton. He's the president and portfolio manager of Black Swan Dexteritas. He wants to take your calls, your emails, and your tweets on technology stocks. So give us a call. It's toll free. 1-855-326-6266. You can send an email to marketcall@bnnbloomberg.ca, or you can tweet us at Market Call. Good to see you again, Kim. Always great to have you here.
Thanks a lot, Greg. Wonderful to be here.
We are fully, especially after the weather we had last Friday, Saturday, in the dog days of summer. I find it interesting you say you've defensively positioned in the short term, trying to protect your gains of the year so far. How long does that short term last?
Well, we've actually built up a fair bit of cash at this point. We're up to about 33% in cash, and we got a pretty big hedge on, But it's interesting when you look at our hedge is about 110% of the remaining stock in the ETF portfolio. But the beta on those single stocks is so high, that's why we've had to put on such a high sort of overlay of a short equity indices. Yeah.
Are you thinking about the second half of the year where we might head after a strong recovery? I mean, we had. I think we forgot almost how much we got whipsawed at the end of 2018 and the dramatic fall off we saw in equities. And then we start a fresh year, everything roars back, and everyone feels great and feels like a genius again. It's like, oh, look how much my stocks are up since January 1st. Great.
But then you had that swoon in May, right? So as we went into 2019, you learned from the past. It's not as though it's going to replicate the past into the future, but in 2018 we had 6 corrections between 5 and 10%, and the big anomaly is that we had 2 corrections in excess of 10%. So we walked into 2019 expecting volatility, and so we've stuck to our discipline of where to take our profit, where to enter back into the market, and knock on wood, it's worked out well for us.
All right. The thing that's interesting, particularly when you're on the show, when we talk about technology, you're always looking at what is coming next and then ways to play that. We have an interesting a graphic we can show about automated driving and all the technology that goes into having a car that can drive itself. Definitely a lot in there, and I guess that opens up a lot of possibilities and opportunities for different ways to invest.
Yeah, this is entitled Sensor Fusion for Automated Driving. What that means, sensor fusion, is that there are really 5 kinds of sensors that go into the cars. And every car will have anywhere between 150 to 200 sensors in there. And then the fusion is where you have different kinds of sensors, but then you have to extrapolate what that means. And so, you can see on the graphic here, a lot of sensors are looking forward because that is so very important. But you have them all the way around the car. Now, just to step back, Greg, this is all about the gradation of automated driving. So remember, and I think we've talked about it before, that you have level 0 all the way up to level 5. Level 0 is where it's just the driver. Level 5 is full automation and operator free. And so right now, most of the automobile companies that are involved in autonomous driving are sort of up to that level 3, which is sort of conditional automation. There are a couple, though, Waymo, which is Google's, who now have driverless taxis in Phoenix. They're actually working on level 4. And then I was just talking with our analyst over in Tel Aviv this morning. They're just going to be launching in August Mobileye, which is the company that Intel bought. They're going to start a level 4 driverless taxi over there.
Incredible.
Yeah. So just if we could go back to the graphic, it's quite interesting because the 5 sort of sensors you have in here is the ultrasound. For a lot of cars these days, the ultrasound is used for parking. And so where you can just sort of take your hands off and you can park. But then you have cameras, you have radar, which is radio detection and ranging. You have LiDAR, which is the light detection and ranging. and then you have GPS. And all of those things are working together, and then you have the chips behind the scene, like that are coming from NVIDIA and Xilinx and AMD, that is sort of fusing all of these sensors and all of this data that allows you to graduate into that autonomous driving.
Yeah, because in the end, that's what my brain does or what your brain does when you're driving. There's all the stuff floating in, and hopefully my brain is taking it all in the same way, making the right decisions about where I should go next. And this is what the computer has to do ultimately.
Right. And I think we have another graphic. Do we have time to show that one?
Sure.
About the cars.
The leading automated driving companies, the 20 leading, this one? Okay.
Okay, so you can see on this, the y-axis is the execution and the x-axis is the strategy. And so up in the upper right, you have the leaders, and then it sort of goes down to the contenders, the challengers, and then the followers. You can see up in the top right, the leader, the one who's out in front of everyone else, is Waymo. But they started this back in 2009. So Greg, it was just exactly what you said, that you learn to drive. Well, this is exactly what Waymo is doing. They started in 2009, so they've got 10 years of data. It's not as though they have different equipment. They just have more data now. So that's exactly why they're out and ahead. But then, for example, you look at Tesla. You always think of Tesla as being a leader. But Tesla uses mainly cameras. They don't get into the radar and the LiDAR, and they do have the ultrasound. But they focus primarily on using cameras for the autonomous driving. So it's a fascinating group.
It is fascinating stuff. I can't wait to get into a car and have it drive me around the town. We'll be back with Kim Bolton, President and Portfolio Manager of Black Swan Dexteritas. Let's answer your questions about technology stocks. To give us a call, it's toll free, 1-855-326-6266. Technology company wants to bring you a little bit of news about Hudson's Bay. Maybe everything's a technology company these days, but we're getting this news out of Hudson's Bay. Private equity firm Catalyst Capital offering to purchase up to 150 million Canadian worth of shares, trying to thwart a proposed takeover of the company. Of course, the proposed takeover would be from the chairman, Richard Baker. What they're offering right now is a 7% premium to Richard Baker's, the chairman's offer for the company. Catalyst Capital trying to move in there and thwart that takeover attempt. So definitely interesting developments on Hudson's Bay. We'll keep an eye on that one for you. Let's go to an email from Ophelia. Facebook, what are your thoughts on Facebook and their attempt of getting into the cryptocurrency space? Libra, such big fans of it up in Washington, aren't they?
Thanks for your question. Facebook, they report on Wednesday, July 24th. It's interesting when you look at the price action. We own a little bit of, we're actually underweight a little bit in Facebook. But when you look at the trading that has been going into this, the reporting on Wednesday, certainly the options bets have become increasingly more bullish. The open calls are massively overweighing the puts there. And the technical charts actually look pretty good. And on top of that, Facebook has a solid track record of beating estimates in the past. So going into the earnings on Wednesday, it's probably a good trade to be long going into that. Now, on the cryptocurrency side, this is going to drag on for a long time. The regulators are going to weigh into it. The politicians are going to weigh into it. But at least they're finally getting their hands and their minds around it. Because they do need someone who has the resources to actually bring this to the public space. But it's not going to come soon.
The thing I find interesting about the fact that Facebook is sort of really asking permission and looking for, Washington, for the politicians to say, we think it's okay for you to do this, because you think about Bitcoin, nobody asked for permission for Bitcoin. I mean, cryptocurrencies didn't show up because the central bank said, gee, I'd really love you to create a competing currency to me and a competing product that I can't regulate. So it's just sort of interesting that I guess Silicon Valley is still licking its wounds from its going through its era of moving fast, breaking things, and not caring, and suddenly turning around and saying, "Oh, look what we've wrought."
Well, I think they're trying to prove that they learned from that whole data privacy side. But on top of that, I think they realize that there's a long runway in this, and it's going to take a long time to actually make some money out of it. But what a fantastic public relations that they've had. Everyone's talking about Facebook in sort of a positive sense.
We have Max on the line from Vancouver. What's your question, Max?
Good evening, gentlemen. Over 5 years ago, I bought a BCE when silly teachers dropped the ball, and it was muddling through, and now it's up 50%. So now I want to take profit and buy what is muddling and in difficulty right now, which is AT&T, and hoping that it will be up 50% also in 5 years' time. I know it has got lots of debt. So what is your opinion about AT&T? I'll hang up and listen. Thanks for taking my call.
Like Max wants to take a contrarian bet here on AT&T and make a lot of cash.
Yeah. Max, thanks for your call. And Max, you have the right idea that you have to look out many years. AT&T is going to profit a lot from the whole 5G deployment that is actually going to take 2, 3, 4 years to actually get out. But you see, the problem with AT&T is that they have to put down a lot of money. The way to play to the 5G deployment right now are sort of like the arms dealers. You remember the Rothschilds? They said, "I don't care who wins the war, but I'm going to invest in the people that actually sell the arms to both sides." So that's sort of how we approach the 5G. So that's, Max, that's why I wanted to take this call, is that the munitions suppliers are going to do very well, the semiconductor companies. But the people like AT&T and Verizon and Bell and
the ones
Rogers,
waging the battle to try to woo us into their camps.
You know, they're having to put down a lot of money up front. And they will make money, but they probably won't make money on the 5G deployment for another 3, 4, 5 years.
Okay, and of course we mentioned Bell there a couple of times. BCE is our ultimate parent company through the Bell Media division. That was from Max in Vancouver. We got a tweet in from Real Salou Khan, the real one. What's your opinion on Netflix?
Thanks, Salou Khan, the real Salou Khan. We don't own Netflix. We didn't get caught up in the swoon that happened last week. I did notice that they now actually have a lawsuit because they missed their new subscriptions by about 50%. And a lot of people say that they should have given guidance in that because they knew it was coming. There are a lot of other companies that we believe have a better risk-reward profile than Netflix at this point. If you see it get down into sort of that 250 to 265 area, it becomes very interesting. But with it still sitting above 300, I'd wait.
I guess the simple story on Netflix right now is the fact that they're not the only game in town, and they're only going to face more and more competition. They might have been the first ones. I'm in a place right now where you're thinking, when I first got Netflix, oh, this is great. I'm paying like $8.99 a month back then, and you're getting all this content, and that's fine. But then people start creating original content. You say, well, that's great too. But then there's a competing service. Now I'm starting to think, wait a minute, is this going to be like the 80s again? And there's going to be a hit show, one on ABC, one's on CBS, one's on NBC, and I have to pay $12 for every station? Like, I don't know if I want to go into that model, because suddenly my TV bill looks as big as it ever did.
And it becomes luck of the draw of whether the money that you put into the original content is actually going to draw the viewers in.
Got Stranger Things Season 3. It looked pretty expensive to me. I think they spent a lot of money on that one. We'll be back with Kim Bolton, President and Portfolio Manager of Black Swan Dexteritas, just to answer your questions about technology stocks. So give us a call. It's toll free, 1-855-326-6266. Got a tweet from Mitesh. What are your thoughts on Micron and the recent uptrend? Is it sustainable? And Micron's been performing quite well in the past couple of weeks.
And they just got an upgrade today. I think it was out of RBC that actually sort of propelled the whole sort of semiconductor side higher today. We don't own Micron as a single stock. We do own a pretty full position, about a 10% position in the SOXX, which Micron is a large position within there. On the single stock side, on the semis, we own Infineon. We're going to talk about that later, I think, and also Xilinx, which is that field programmable. So, you know, Micron, even after the recent run, is still pretty cheap, and you know a lot of the price targets are considerably higher from this point, sort of sitting up in sort of the high 50s.
That's trading less than 8 times forward earnings.
Yeah, it's still very, very cheap, and you know, this is the company that sells memory and storage solutions worldwide. It's a leader in that. We like having the diversification and the flexibility of actually participating in the semiconductor side with the SOXX.
Andrew's in Keswick calling in. What's your question, Andrew?
Yes, hi. Thanks for taking my question. I'd like to ask Mr. Bolton about the exchange-traded fund XIT. I'm wondering what's actually in the fund, and is this a good way to get a basket of Canadian technology stocks? Is it a buy here, or would you recommend something different?
All right, play on Canadian tech. I can tell you the biggest holdings are Shopify, CGI, Constellation, and OpenText.
Which are all based on market cap. So Andrew, thank you very much for your call. It's a great play on the Canadian technology arena. We tend to go broader in our fund in a global context. Mind you, we do own off and on Canadian single stocks in here. We've owned Shopify and Constellation and CGI, and but we don't own it right now. And what I would recommend, you know, in the technology arena, sort of the 3 pillars that we have within our portfolio are the semiconductors, the internet stocks, and the software. So Andrew, if you're looking for ETFs to actually participate in a global context, on the semis, I'd recommend going into the SOXX. In the software, use the IGV. And in the internet side, the FDN. And you'll get that global perspective. If you're going to use an ETF, you might as well try to get the diversification around the globe.
Okay, we're going to take a little break. We're going to come back. The past picks are coming up next. Time for the past picks. We go back to July 9th of 2018. You liked Red Hat, and it's a 34% return since then.
Well, it's actually been taken out. It was taken out by IBM.
IBM on July 9th. Whoa.
Yeah. So
a year to the day that you picked it, it got taken out.
Well, no, it actually got taken out by IBM back on October 28th, 2018.
Okay, but closed on July 9th.
Right.
There we go. Closed.
Exactly. And so we actually picked it up at just shy of $63, and then we actually sold it on the day that it was announced back on October 28th. We sold it at $174.50. You know, Red Hat is a leader in the open source side. It's positioned to continue that. But it's interesting why IBM spent $34 billion on this company to buy it. Why'd they do it? Well, because they really needed a catalyst to get them in as a major cloud provider. And except for Microsoft Azure, the cloud is basically built on Linux and open source software. And so this really helps out IBM. Second of all, it's all about investing into the open source. And so it probably begs the question, you know, Kim, did you buy IBM with the proceeds? And no, we didn't. I look at IBM less as an investment and more as a trading. So you sort of trade it between sort of 130 and 170 on the wide. And so that was Red Hat. What was the other one? Twitter.
Oh, if you steal my job, then I won't have anything to say. The next one is Twitter. See how valuable I am to the program?
Thank you, Greg.
Twitter. Here's one I can never understand. They are in the news every single day, multiple times because of Donald Trump. You cannot ask for more free advertising than that. What's going on with the name?
You know, we bought Twitter, it would go back into 2017. I remember we actually owned it with an average price of about $17.50, and we sold it in the low 30s, which isn't that far from where it is right here. So we don't own it right now. You know, if it comes down, you're bound to have another one of these, if not multiple market swoons, and I'm sure you'll be able to pick up Twitter in the high 20s.
Now, the maker of my favorite video game when I was 11 years old, maybe 12 years old, River Raid. Activision made River Raid way back in 1982, 83. Still in the video game business, not doing that well, though.
Yep. So these picks go back to July. We actually sold out of it, thank goodness, in the early fall. And, you know, within our investor base, we have a lot of serial tech entrepreneurs that actually look to us to manage their publicly traded technology portfolios. And many, probably two handfuls of those investors are involved in the gaming industry. And so we know the space very well. But it just got all hyped up going into the summer and certainly in the fall of last year. So we actually sold out of it. Now, Activision Blizzard, it's sort of, as you can see in this chart, is just sort of sputtered around here. Our price target on this is $56. But they're working through some reorganization. You have Activision, which was the original. Then they bought
Pitfall, River Raid.
Yeah. And then they bought Blizzard, or merged Blizzard in, which was really sort of the hardcore console gamers out there. And they've really had a difficult time digesting. But with the pivot toward mobile and, you know, the new revenue opportunities that is going to afford them going into later this year and certainly into 2020, this is why we still follow Activision and Take-Two and Electronic Arts, because there will be an opportunity to actually buy into those this year.
Yeah, we'll be back after a short break. The number 1-855-326-6266. We are talking tech stocks, so send us your questions. We have Tyler on the line from Toronto. What's your question, Tyler?
Yes.
Hello, Tyler. Sound like someone just cut him off, like they didn't want Tyler to say what he had to say on live television. Probably the Russians. Uber. You wanted to talk about Uber.
Tyler, thanks for your question. Uber. First of all, we don't own it. We didn't go in the IPO. I wanted to take the question about Uber because, you know, this is a great example of the IPOs that come in and there's so much hype, but they don't give guidance of when they're going to make money. Same thing with Lyft, right? For those IPOs that come in and actually have a business plan and can articulate that this is when they expect to make money. Maybe it's not this year, maybe it's not for another 5 years, but at least they have a plan. Now, the other thing I'll say about Uber is that they're such a massive company, and they're involved in so many things, and they're so innovative and a disruptor. It very much reminds me of Alibaba. Remember when Alibaba came out, and it had an IPO price, I think, down the NASDAQ of around in the high 70s, and it just struggled for months and months, and then it got its feet under it. So I would recommend, Tyler, if you're looking to buy Uber, if you can get it in sort of the mid-30s, US dollar version, it's probably a good long-term hold.
Street has 23 buys, 11 holds, 0 sells on Uber Technologies. We have Harry in Brantford. What's your question, Harry?
Thank you for taking my call. May I know about BlackBerry, please?
BlackBerry. All right, let's check it out. We've heard of them.
Yep. Thanks, Harry.
They used to rule the world.
Thanks, Harry. BlackBerry. This is another one of those stocks, single stocks, that we don't invest, but we actually do trade. And we're actually looking at it very, very closely right now because it is, in US dollar terms, is trading under $8. Do you have the chart handy?
We might have shown, we showed the TSX listing, so it was 933.
Oh, okay.
But I can pull up the American one on my screen.
And so I think it's just trading in sort of the high 7s. And so the reason that we're watching it very...
There you go. There's the New York
732. Yeah. We'll look to actually buy it if you can get it down just not too far from this point. You can see that it actually got down in that swoon back at the end of last year, down to this level. They've got the right idea with the acquisition of the Silene, and it has really given them great credibility around the world and a longer runway, a revenue runway. So we find it interesting around this level.
You feel like John Chen has the right idea then? I mean, it's never going to be the company that it used to be. And I guess at some point, they're putting it further and further in the rearview mirror. But this is a tech company. It's a software company. It's not a telephone company anymore. Are there still investors who can't seem to forget that?
Yeah. Well, it's a difficult transition from, hardware to a software. But look at some of them have done fabulous jobs. Look at Cisco. Cisco has done a phenomenal job of really building up their software side and getting that recurring revenue growth that you can actually get out of the subscriptions of software as a service and so on. And so, BlackBerry does have the right idea, and I think it's actually fair. It's pretty interesting down in this level.
I will say with the old BlackBerry QWERTY physical keyboard, I could type out an entire story with my thumbs from court when I was reporting on stories like that. And now with the new phones and that, I can't even, it takes me 10 minutes to tell my wife I am on the train, the 5:45 train. That takes all day. I used to write entire stories for newspapers on an old BlackBerry, so kudos to them on that. Danny in Pickering. What's your question, Danny?
Yes, thank you for taking my call. My question is for Alibaba. They're going to be listed in Hong Kong now. What that means for the holders, for us that are holding their stock in New York, and also, please, what do you think long term? Do you own the Alibaba? Thank you.
Yeah, the Hong Kong listing, we get lots of calls about that, what it means for Alibaba.
Well, it's certainly going to give them a lot more liquidity out there. We don't own it. We used to own it, but then as we went into the Trump and Xi talks that were going over in Kyoto, we just sort of backed away from all of our Chinese stocks. Alibaba, it's one of the top 10 biggest tech companies in the world, and is really involved in so many facets across commerce and cloud computing and digital media and all kinds of innovative initiatives. Currently trading around 174. I would bet that you could probably pick this up closer, certainly under 150, if not closer down to 125. So I wouldn't chase it at this point. But this is going to be another year and a half before the elections, where you're going to have a lot of volatility, and you'll have the opportunity to actually pick this up cheaper, and it should be part of your portfolio, but trade it rather than invest in it.
Keep your eyes on Baba. We'll be back with Kim Bolton, President and Portfolio Manager of Black Swan Dexteritas, to answer your questions about technology stocks. So give us a call. It's toll free. 1-855-326-6266. Stephen in Vancouver. What's your question for us, Stephen?
Hello.
Hello, Stephen.
Thank you for taking my question, sir. I was wondering if it is possible for your guests to talk about an technology ETF, so that for novice like me could buy on for my RRSP, because I really don't know anything about it, and I even made the mistake of buying the Mac Store technology. So if you could just ask your guests to guide us into a
nice basket.
ETF.
I guess a nice basket, right? You don't get stuck in one name that if it falls apart, you're in trouble.
Yep. Thank you very much, Stephen, for your call. Stephen, I would recommend 3 ETFs, and you can do three ETFs.
Now, you're not stealing your thunder at the end of the show, are you?
No.
All right. The guy, Kim knows how to play this. Sometimes people do that. You wouldn't believe that. They steal their own thunder. Sometimes I steal their thunder. But
the 3 ETFs, Stephen, I'd recommend is, number one, the SOX, semiconductor. You know, it is the ammunition that drives technology around the world, with chips and equipment makers for the foundries and so on. The second one, Stephen, I'd recommend is the IGV. And this is the IGV, the iShares Expanded Software Sector ETF, is a great way to get that diversification around software, because software is where it is. Now, mind you, hardware is coming back because of the whole 5G deployment and so on, but I'd recommend the IGV. And then the third one, Stephen, that I'd recommend is the FDN. And the FDN is the Internet Index that comes from First Trust Dow Jones. They're extremely liquid, massive, and then you get the 3 pillars that are really sort of driving the technology arena from the vendor side of things. Yeah.
I haven't thought about the FDN for a while. Amazon, Facebook, PayPal, Netflix, Alphabet, eBay, they're all in there.
And the reason we actually use the ETFs, certainly this year, is because of the volatility. And it allows you, you know, we go in, we have price targets, and we have entry points. And then when we get within sort of 5, 6, 7% of price target, we take a third off. When you get to price target, you take another third off. When it goes through the price target, you cash the rest of it out. And the ETF, see, if you have single stocks, you can't be as nimble and as flexible. And you can still have those price targets. And likewise, you know, we did that. We took our profit, for example, in the FDN, the IGB, and the SOX, going through sort of March and April, and then we had a lot of cash on our hand. Then you had the swoon in May, and it came back to our price target, and we got filled in. So those are the ones, Stephen, I'd recommend.
Don on the line from Ottawa. What's your question, Don?
Yeah, thanks, Greg. I've recently been taking profits in CGI and casting around, and I'm opening positions in open text. And I wonder what you think of that idea. Thanks.
Open text. All right, let's take a look.
Yeah. Thanks, Don, for your call. We don't own it. We follow it. And it is, again, in this sort of software as a service, in actually doing consulting and actually providing software services for enterprise integration into various things, all the way from the cloud to even single software services. It is one of the leaders here in Canada. It's pricey up here, and Don, I'd recommend, if you can actually get it in the mid-40s, that would be the place to actually buy it. And I think you'll get a chance this year.
That might be a pullback then. It's been on a great run. The earnings coming What does that look like? That looks like August 1st to me, right at the close of markets for open text. Dave in Toronto, I believe this is our young investor. What do you got for us tonight, Dave?
Hi, Greg. Greg, thank you for taking my call. My question is about Square. Visa, MasterCard, these payment processors have really risen in cost, the stock price, and Square has also. I wanted to ask him, what does he think of Square? Does he hold it? Would he recommend it for a young investor? It's probably above its fair value, but knowing it's a growth stock, I would like to purchase it, but I want to know what he thinks about it. Thank you.
All right, what do you think of Square?
Thanks, Dave. Yes, we own it. We don't own a full position on it. Just last week, we took a third off because it got within our price target, up at 82.5, and so you're getting pretty close. And so once it gets up to 82.5, we'll take another third off, and if it happens to go through there, we'll cash the rest of it out. They are a disruptor, an innovator in that space of PayPal and Visa and MasterCard, sort of the legacy companies out there in the fintech. But it's a great one to actually own. I'm pretty sure that you're going to have the opportunity to actually buy this back in the low 60s.
Really? Okay. 18 buys, 17 holds, 3 sells on Square. We'll be back with Kim Bolton, President and Portfolio Manager of Black Swan Dexteritas, to answer your questions about technology stocks. So give us a call. It's toll free. 1-855-326-6266. We got Gary in Midland on the line. What's your question, Gary?
Thanks, Greg. I'm interested in the cybersecurity area because it seems to me it's coming, and it seems to me it might be somewhat resistant to a recession. Don't know a whole lot about it. Would I be better off with an ETF like Hack, or is there a particular stock that you really like? Thanks. Bye.
That's a good question. Yeah, play the basket or pick a winner?
Yeah. Thanks, Gary, for your question. It's interesting. We back in May, we started to buy into the Hack, and we've got actually now about a 6.5–7% position in the Hack. So it's a pretty full position. We like it again because of the diversification and also the flexibility that it gives us, that we can actually take some profit on it. And the diversification, you look at the top 5 holdings in the Hack, it's Cisco, CyberArk, Sophos, Akamai, and it sort of works its way down into Splunk and so on. On the single stock side, in the cybersecurity sector, we also own Palo Alto. And the reason we bought Palo Alto, I cannot for the life of me understand why Palo Alto is not part of the Hack at this stage. And so, I'll talk about it later on the top picks, but it's really the dominant player within the cybersecurity. But Gary, I'd recommend buying into the Hack, where we took profit on the KWEB, which was the Chinese internet, and also on the bots, which is the automation and robotics, and actually entered into the Hack. Yeah.
We have an email from Victoria in Halifax who wants to talk about Samsung. Do you see Samsung getting hit in the crossfire between the United States and China?
Thank you very much for your question. Yes. We actually owned it when we walked into the beginning of the year, and we looked for an opportunity to actually get out of it. I look at Samsung sort of the way we look at Apple. Samsung is such a huge conglomerate, as is Apple, that it's often better to buy the sum of the parts and the supply chain that sort of comes behind it, because there are so many moving parts behind Samsung. They're massive into the semiconductor side. They're massive into the appliances and also into the smartphone market. But they get, because they're so big, they're used as a pawn in these geopolitical battles out there. And so one way you can actually get diversification around that is actually to buy some of the supply chain, like the semiconductor stocks, or even the semiconductor equipment makers and so on, that are actually helping out Samsung.
In your investing, given how important some of these macro themes are, including the global trade war in the United States and China, do you try to gauge the longevity of this trade war? I mean, do you have any positions based on the fact I think they're going to find a resolution in 6 months or a year? Or is that just too tough to try to figure out?
Thank you for asking that, because that's our namesake, Black Swan. Like, black swans are unexpected events. We can't predict them, but what we can do is we can position a portfolio around that. So our namesake is Black Swan Dexteritas. It's all about prosperously navigating unexpected events, black swans, with great skill and agility, the Dexteritas side of it. And so this is precisely why we stick to the discipline of where we're going to enter, where we're going to exit, and then we put a derivative overlay on top. You know, short equity indices like the S&P and the NASDAQ and the Russell and the DAX and so on. Everything is correlated against the portfolio, so we have a very, very nice optimal short overlay, and that actually brings down the volatility and it lessens the drawdowns. So, for example, in May, the NASDAQ was down 8.5%. The S&P was down 7.5%. We actually came out of May with 0.7. Mind you, we went into June, everything snapped back, and so the S&P was up 6%, and the NASDAQ was up 7%, and we were up 3.5%. But it just prosperously navigating unexpected events, that's what we do to actually bring down the insurance and the volatility within the portfolio.
We're going to take a little break. When we come back, the top picks coming up next. It's time now for the top picks. We got 3 minutes, 3 names. It can be done. Alphabet, why do you like it?
Google, price target on this we have is $13.50. It's right now sitting at $11.40. So it has a long runway. You know, Google is one of the best positioned companies to benefit from those secular trends of digital advertising. But then they have all these non-advertising revenue streams, from Google Cloud into hardware. They're going to be coming out with this on their Pixel and Pixel Watch, something that I'm really excited about, which is the Project Soli, and that's about having a miniature radar on your phone. I think it's going to change a lot of things out there. And then on top of it, remember we were talking about the autonomous driving. This is what gives Google such a long, long runway, because they got Waymo, which is a leader of autonomous driving.
Infineon Technologies is next on the list.
Yeah, we've been in and out of this. We actually had taken all the profit on this back in May, and then back in March and April, and then in the swoon in May, it gave an opportunity to actually buy right back in. So we've got a price target on this of $28.50 US. Infineon, they're a Dutch-German company. They're a leading supplier of chips and power management, primarily related toward electric vehicles and automated driving. You may recall that they just bought Cypress Semiconductor. This now makes them the #1 auto chip company in the world, eighth largest semiconductor company. So we've got a 3.5% position in Infineon. We'd grow it up to 5%.
1 minute left, one name left, Palo Alto Networks.
This goes along with, we were just talking about the hack ETF on the cybersecurity. Really like Palo Alto. We've been in and out of this over the last sort of 5-6 years. They're a dominant player in the cybersecurity side, but they're cheaper. They're cheaper than a lot of their competitors. Sure, they have a PE ratio of 42 times, but when you look at companies like Proofpoint, which are 73 times, and CyberArk, which is 91 times, they're actually fairly valued. So they constantly beat. They're just reliable. Now, earlier this year, they did struggle because they were going out of licensing into subscriptions, but I think you'll see this actually snap back.
Perfect timing, Kim. Always great to have you here. Look forward to the next time.
Thanks a lot, Greg.
As always at home, please consult a qualified financial advisor before making any investment decisions. I know you got me over there. Thanks for joining us. Hope to have you with us here tomorrow.